And the IRS allows us, instead of waiting 27, 30, 35 years to write all of that off, we're able to write it off in the first year.
Okay, I'm going to stop you right there. Hi everybody, thank you for watching our videos on syndication. So we're talking about syndications, and this video we're going to talk about tax write-offs. Individuals' residential home tax write-off versus multifamily tax write-off, what are the differences there?
Yeah, and if you really want to understand the tax code, talk to your CPA for sure. We're not giving tax advice.
Right.
But what we've noticed over the years of buying these large multifamily assets versus the single family assets is there's so much more to depreciate on a large asset compared to a home. And the IRS allows us to do what's called a cost segregation study. We actually pay an engineering firm to go to the property and determine how much of everything that's in that property that we can write off. And the IRS allows us, instead of waiting 27, 30, 35 years to write all of that off, we're able to write it off in the first year.
Okay, I'm going to stop you right there. So there's a technical term called cost segregation. You may want to Google it. But basically, it's, let's say, a multifamily project. If you need to replace the roof, for example, you don't need to depreciate over the next, 30 years, 27 years? You kind of accelerate everything up front. Is that kind of what's...
Yeah, the IRS decided, you know what, we know Grace is never going to own this multifamily property for 27 years or 35 years, whatever the code says. And so they're going to allow, and they also know the roof isn't going to last that long.
Right.
So they allow you to depreciate it over a much shorter schedule. They also know a dishwasher isn't going to last 20 plus years.
Right.
They know the water heater isn't going to last 20 plus years. So the IRS, to incentivize people to be good landlords and maintain their properties and buy more properties and provide good housing for people, they've allowed us to depreciate those assets over a much shorter schedule.
Okay.
Which saves us a lot of money.
Let's talk about that in terms of what investor like myself get using cost segregation is because you accelerate all that depreciation up front. That means I'm going to get a bigger, write-off. Meaning passive loss. Is that the same thing as passive loss in my years of owning this property?
Right.
So passive loss will be, what can we do with passive losses in times of tax return?
Yeah, I mean, if you have investments in the stock market or any other passive investments, these losses that we generate, I mean, you're still cash flowing from our property, right? But on paper, you're generating losses.
Big loss.
Big losses. And so those losses offset any income from our investment that you're receiving or any other passive investments that you've made. And so
that's including stocks?
Anything that's passive, yeah. If you're not an active stockbroker and that's not your job, that would be a passive income.
So that means if I make money in stocks and I sell them and I have a passive capital gain, that would be a passive gain. Yeah. And then I can offset these gains using these passive losses.
My favorite example, so yes, you're correct. My favorite example is, well, if we're making you 8 to 10% a year on this, let's say this El Paso property that we purchased, and we've generated a $50,000 loss, well, it could be 5 or 6 years of having that income completely offset by the passive loss that we generated. So that's tax-free income for 5 to 6 years.
Yeah.
And that's huge. So maybe you thought you were going to get a 15 to 17% yearly return, but now if you know you're not paying taxes on that money, you're probably closer to a 20% return per year.
That's huge. Making money from your syndication investment and saving taxes. Like in California, we know we pay a lot of taxes. As you know, we have really high state tax. So that's actually you making their benefits to investors.
And one thing people don't understand is that's a huge benefit, but cost segregation study is expensive. It's anywhere from $5,000 to $15,000 to have the cost segregation study done. So if you own one home for $500,000, it probably doesn't make sense to do that, and because you're going to generate 10 to 15,000 in losses. So financially, it doesn't make sense to do cost seg typically on homes or duplexes because there's not enough losses generated. By investing in a syndication, pooling your money with your friends and these other investors, now it makes a lot of sense financially to depreciate this asset and pay for that cost segregation study.
Yeah, that makes a lot of sense. So that's what we talked about, economy of scale, because it's a bigger project, 200, 300 doors, you have more investors, more money, more expertise, more professional expertise, so you can afford that kind of professional analysis on your project. So I think that's amazing.
We love it. You know, Grace, there's a lot of investors that most of the reason they're investing with us is to receive these passive losses. They love the cash flow, they love the upside, but they really love the tax losses.
In California, we love ways to save taxes for sure.
Everyone does.
Okay.
Yeah.